Now speaking, Kevin Walker, Vice President, Investor Relations. Dollar General CEO, Jeff Owen, President, John Garrett, and CFO, Kelly Dilts, held an earnings call today. During the call, they addressed topics such as financial guidance, strategy, vision, initiatives, plans, goals, priorities, opportunities, investments, customer expectations and beliefs about future matters. All these topics may be subject to risks and uncertainties that could cause actual results to differ from expectations. Dollar General has filed a 2023 Form 10-K on March 24, 2023, which outlines these risks in further detail. At the end of the prepared remarks, the call was open for questions. Now speaking, Jeff Owen, Chief Executive Officer. Despite a more challenging macroeconomic environment than previously anticipated, Dollar General delivered progress across multiple fronts including supply chain recovery efforts and improved customer experience in Q1. Same-store sales grew 1.6%, driven by increased basket size, partially offset by a decrease in customer traffic. Headwinds included lower tax refunds than customers expected and reductions in SNAP benefits, as well as unfavorable weather during the months of March and April. Net sales increased 6.8% to $9.3 billion. To support customers who are under greater pressure than normal, Dollar General is taking action to provide even more affordable solutions and lower prices for customers, leaning into their save-to-serve approach and refining their inventory management process. They are also moderating their rollout of P-Off-Shelf in 2023, opening approximately 90 stores compared to their original expectation of 150. Despite near-term headwinds, Dollar General believes they are taking the right actions to serve their customers and remain confident in their ability to deliver strong and sustainable growth in the years ahead. Now speaking, Kelly Dilts, Chief Financial Officer. Summarized, Dollar General's Q1 gross profit as a percentage of sales increased 34 basis points to 31.6% primarily due to higher inventory markup, decreased transportation costs and a decreased LIFO provision. SG&A as a percentage of sales was 23.7%, an increase of 94 basis points driven by retail labor, repairs and maintenance, depreciation and amortization, and incentive compensation. Operating profit for the first quarter decreased 0.7% to $741 million, while interest expense increased to $83 million. EPS for the quarter decreased 2.9% to $2.34. Merchandise inventories were $7.3 billion at the end of the quarter, an increase of 14.7%. Cash flows from operations of $191 million decreased 57%. Total capital expenditures were $363 million. The company revised its outlook for 2023 to reflect macroeconomic headwinds, expecting net sales growth in the range of 3.5 to 5%, same-store sales growth of 1 to 2%, and EPS in the range of an 8% decline to flat. Capital spending is expected to be in the range of $1.60 to $1.7 billion, and no share repurchases are planned for the year. Now speaking, Jeff Owen, Chief Executive Officer. Dollar General is focused on executing their strategic framework, DG Forward. This roadmap emphasizes the combination of execution and innovation to serve their customers, employees, communities and shareholders. The strategy includes 4 key areas of focus: serving rural customers, extending their reach, strengthening and modernizing their operating model, supply chain and IT foundation, and investing in their people. In Q1, they opened 24 new P-Off-Shelf locations and plan to open 230 stores by the end of 2023. They also expanded their DG Fresh initiative and added 18,000 cooler doors across their store base with plans to install 65,000 additional cooler doors in 2023. They also launched their health initiative, DG Wellbeing, in 5,000 stores with plans to expand to 7,000 stores by 2023. The company is also expanding their digital offerings, including driving customer engagement through their app and partnering with DoorDash. They are also leveraging their Mi Super Dollar General store in Monterrey, Mexico with plans to have up to 20 stores by the end of 2023. Their second priority is capturing growth opportunities. In Q1, they completed more than 800 real estate projects, including 212 new stores, 582 remodels, and 22 relocations. For 2023, they plan to execute 3,110 real estate projects, including 990 new stores, 2,000 remodels, and 120 relocations. They are also focusing on cost savings and leverage their position as a low-cost operator. They are utilizing their Fast Track initiative, which includes self-checkout in 12,600 stores, and expanding their private tractor fleet. Finally, they are investing in their diverse teams by providing development, empowerment, and inclusion opportunities. They have an internal promotion pipeline with 70% internal placement rates and 10% of their private fleet teams starting their careers in either a store or distribution center. Morgan Stanley analyst Michael Kessler inquired, Jeff, what are the root causes of Dollar General's supply chain, labor and macro challenges in the last 6 to 9 months? How can investors be sure all the issues have been identified? Jeff Owen replied, in response to the question, I'd say that while we faced challenges in our supply chain late last year, we improved it faster than expected and ended the quarter with our best service level in 2 years. Additionally, our customer is responding positively to our investments in labor hours and pricing on items that matter most to her. Despite some macroeconomic headwinds in March, we are seeing our customer return and are pleased with the progress we're making on our strategic initiatives. We're well positioned for the long term. J.P. Morgan Chase & Company analyst Matt Boss inquired, Jeff, could you speak to the changes in customer behavior that you've seen in terms of traffic versus ticket? What drove the May comp improvement? Where do you stand with the 1% to 2% updated full-year comp guide? Jeff Owen replied, thanks, Matt. Our customer is facing greater financial pressure than we've seen in a long time. Food inflation persists, and the removal of the child tax credit has impacted her tax refunds. SNAP benefits have been reduced on a per-household basis, which our data shows is causing customers to rely more heavily on food banks, savings, and credit cards for necessary items. We're seeing customers buy fewer items per basket, utilize $1 price points, and shop closer to payday. Despite this, our actions are having an effect, with share gains in April and May. We feel good about our position to serve our customer in times like this, as 80% of our stores are located in communities of 20,000 or less. J.P. Morgan Chase & Company analyst Matt Boss inquired, Kelly, what actions do you plan to take regarding your pricing position and how does it impact your gross margin forecast for the second quarter and back half of the year? Kelly Dilts replied, in response to the question, I would say, our pricing position is strong and we are investing in targeted everyday low price initiatives. Our revised guidance reflects the macroeconomic environment, which puts pressure on sales and shrink. We're actively managing the P&L, working capital and capital investments while not sacrificing long-term growth. Q2 will be the most challenging quarter, as it will feature the most pronounced headwinds and a lower gross margin rate compared to Q1. Interest expense, labor investment and our price initiatives will all contribute to this. However, we expect sustained benefits from these investments and believe that history shows we can emerge from this environment in an even stronger position. Q4 should have the best comp of the year as we move into 2024. UBS analyst Michael Lasser inquired, Jeff, given Dollar General's large store count and invigorated competitors, is it becoming more difficult to gain market share and therefore have a structurally lower margin moving forward? Jeff Owen replied, thank you, Michael. Dollar General has historically been a share gainer and we continued to be one this quarter. Our non-consumable business saw growth while highly consumables were flat. In February, we had healthy comps and share gains. We saw a pullback in March as our core customer was disproportionately impacted by macro pressures. April saw the return of our customers and growing share, which resumed into May. We have taken actions such as pulling forward labor investments, supply chain improvements, and getting sharper on pricing to make our offering more compelling. Our structural profitability is enabling us to continue to grow share and margins, providing healthy returns. We look forward to continuing to serve our customers and driving strong results into 24 and beyond. UBS analyst Michael Lasser inquired, Jeff, what steps are you taking to ensure that investments in price do not result in a never-ending price war within the small value retail sector? Can you make these investments and still get back to your double-digit EPS growth algorithm within a reasonable time frame? Jeff Owen replied, our pricing philosophy has not changed. We are aiming to be within 2 to 3% of mass market prices plus or minus. In recent weeks, we have taken a targeted and surgical approach to being there for customers when they need us most. Our actions have been in line with our guidance, and this has been met with a positive response. Kelly Dilts replied, Jeff is correct, the guidance we provided takes into account sales scenarios and any shrink risk is largely offset by our cost-saving measures and SG&A. We are confident our EPS guidance will be met with the actions we are taking, and our long-term goal is 10% EPS growth. Credit Suisse analyst Karen Short inquired, what is your estimated sustainable EBIT margin? What visibility did you lack in March that caused you to change your stance on SNAP reductions? Do you still feel confident in outperforming a weak macro with a trade down in your format? Jeff Owen replied, in response to the question about SNAP and the customer's current economic position, I can say that when we discussed this issue at the end of Q4, we had not yet seen the full impact of SNAP changes. However, our first-party data indicated that customers in states that had previously cut back on SNAP were responding accordingly. Since then, we've seen our customers pull back due to both SNAP changes and a reduction in tax refunds. Our model is built for all seasons and we still believe we can serve our customer well regardless of the economic environment. We are now focused on serving our customer even better than before and are uniquely positioned to do so given 80% of our stores serve communities of 20,000 or less. Kelly Dilts replied, I'm confident that our initiatives will achieve continued operating margin expansion through 2024, despite the macro environment. We are investing in those initiatives to ensure we reach our goals. Credit Suisse analyst Karen Short inquired, what do you anticipate your EBIT margins to be in the upcoming fiscal years? Kelly Dilts replied, I'm confident that what we're doing now will ensure a successful 24. We are taking all the necessary steps to position ourselves for success and I'm confident that our efforts will pay off. Oppenheimer & Company analyst Rupesh Parikh inquired, can you provide some insight into why the comp shortfall this quarter is more attributed to macro factors rather than changes in competitive dynamics? Jeff Owen replied, as I mentioned, February started off strong and we saw a pullback in March and April. However, our customers have responded nicely in May. We attribute this rebound to the macroeconomic shock combined with a cold and wet spring. Additionally, our supply chain has improved significantly since Q4 and we are seeing a significant improvement in store conditions. Our customers are telling us that value is still incredibly important and we believe that by continuing to show value we will be able to drive traffic into our stores, better serve our customers and gain share. Oppenheimer & Company analyst Rupesh Parikh inquired, what opportunities do you see to improve your inventory position, given the 20% year-over-year increase? Kelly Dilts replied, inventory remains a focus for us. We acted quickly to reduce non-consumable receipts by over 30% in Q1, resulting in a 3% reduction of the inventory per store from Q4. And while our supply chain service levels improved faster than expected, we expect non-consumable inventory to return to more normalized levels by the back half of the year. We have a new structure in place to ensure that inventory remains in line with sales. Jeff Owen replied, thank you for your questions and interest in Dollar General. To summarize, we are well positioned to serve our customers during this time, and have invested and adapted to do so even better. We have a clear vision and growth strategy that will drive momentum in the coming years. Thank you for listening. Have a great day.